we're hearing more and more concerns on Wall Street that the surge in AI investment is starting to resemble a bubble.
Are we in an AI bubble? Of course.
These companies are considered major drivers of the AI trade, and they make up about a third of the S&P 500. When one of these stocks moves up or down, they can take the entire market with them.
All right, soldiers, we've got to discuss this issue with AI. Now, the mainstream media, they're celebrating record-breaking stock prices associated with these companies. But the financial plumbing underneath the AI boom, that plumbing is leaking. It's got a huge problem. We're not so much looking at an AI revolution as we're looking at a circular liquidity trap. We're on a merry-go-round of funding and financing that is not as genuine as we might think. And this has definite ramifications for your retirement savings, your 401k, your IRA, any assets that you have out there that you're using to plan for your future. Now, I've been analyzing the data from this entire thing, all right, and taking a really close look at what's going on in this circular AI economy. And what I've discovered is that there's a $1 trillion loop, roughly, of fake demand that is being used to prop up your retirement accounts. So today we got to take a look at this AI debt trap, and I'm going to show you how to pull your assets out of the danger zone before the 2026 reset snaps the trap shut.
We're taking a look at 3 charts that help explain what's going on. This first chart takes a look at the concentration of the S&P 500 in the information technology and communication services sector by market cap. And you can see here that the concentration has reached levels last seen during the dot-com era. One worry is that this creates really high expectations for these companies. Something like a negative earnings report or even a positive earnings report that isn't considered positive enough could have an outsized impact on the stock price of a company like Tesla or Nvidia, and therefore an outsized impact on the whole market.
All right, it's very important to understand that this comparison is being drawn between what we're seeing today in AI and the tech bubble of 2000, and we all know how that worked out, right? We all remember how much value was lost, how net worths and retirement accounts like 401ks and IRAs were affected.
Let's take a look at the late 1990s into the early 2000s, an era known as the dot-com bubble. This was a period when the NASDAQ composite climbed 500% over the course of 5 years. Small investors stampeded into speculative technology stocks, lured by the promise of another innovative technology at the time, the internet.
The worst hit shares around the world have been the technology stocks, including the dot-com companies.
Unfortunately,
all right, another similarity we have here between the dot-com bubble and where we are now with the AI is that during the dot-com bubble, it was still unclear exactly how the internet was going to make money. Remember, it was all about eyes on pages. It wasn't necessarily about profit. Yes, we got into an era, ERA and ERROR, that some, too many actually, believed that it wasn't about profitability.
that bubble burst, and it took several companies down with it. That brings us to chart 2, Amazon, Alphabet, Meta, and Microsoft. This takes a look at their capital expenditures by quarter, and as you can see, it's increased a lot in recent years. A lot of the spending is on infrastructure like data centers, a very costly, speculative bet that this technology will rapidly improve, remake the economy, and eventually start turning a profit. The big question here is when and how all this AI investment will pay off. One estimate from Bain & Company found that AI infrastructure will require $2 trillion in revenue by 2030 to justify current levels of spending. That's leaving investors wondering when and how they're going to start to see profits. That brings us to our last chart, which shows us profits and free cash flow for those same 4 companies. Free cash flow is an important metric for investors because it shows what's left over at a company after they pay their operating expenses and capital expenditures. One key difference between today's market leaders and those of the dot-com era is that these are mature companies with profits and cash on hand. By contrast, 25 years ago, a lot of the most popular bets were companies without profits that were burning through cash at any cost to grow. It's hard for anybody, even professionals on Wall Street, to tell when we're in a bubble. But thinking back to 25 years ago, investors remind me that the thesis was right. The internet did change everything, and it remade the economy. But it could take years for this dynamic to play out now.
Right. So we have to understand and be very discerning about what is irrational exuberance and what actually represents real true value. And we're not seeing real true value necessarily in the companies that are actually engaged in providing AI as a service. We're not seeing that yet. And that is very, very troubling.
At the center of this web of AI deals are OpenAI, the maker of the widely popular AI chatbot ChatGPT, and Nvidia, a maker of GPUs used to power AI. Just this year, OpenAI alone has made around $1 trillion worth of AI deals.
They've made $1 trillion worth of AI deals, and although they're not a public company, their supposed worth is somewhere in the neighborhood of 500 billion, maybe. Okay, we don't know. They're not a public company, but they sure are making a lot of high dollar deals for a company that is not even publicly traded just yet, and who everybody agrees they don't have the assets that would justify them being able to make such hefty investments.
Closer look at some of these. In September, OpenAI confirmed that it would pay Oracle $300 billion for computer infrastructure over the course of 5 years. This deal is part of a $500 billion data center build-out project called Stargate, to which Japan's SoftBank Group is also contributing. OpenAI has also inked a $22 billion deal with CoreWeave for use of its data centers, which are packed with Nvidia GPUs. OpenAI has another cloud deal with Google for an undisclosed amount. The company is also partnering with Broadcom to develop and deploy racks of OpenAI-designed chips. That deal amount is undisclosed. Part of the reason OpenAI is able to go on the shopping spree is because of a $100 billion infusion from Nvidia, though a large portion of this investment will likely be used for leasing Nvidia's GPUs. Microsoft has also invested about $14 billion in OpenAI since 2019. Recently, OpenAI has also announced a deal with AMD, where OpenAI agreed to purchase AMD chips in return for a stake in the chipmaker.
They're going to get to take up to a 10% stake in the company over time. So that's a pretty substantial equity investment for OpenAI.
Nvidia has made a similar amount of intertwining deals.
All right, so you start to see how incestuous this is. So let's dive a little deeper into the actual nature of the revolving relationship that we see developing here. This isn't just investing, okay? It's a 3-step financial engineering tactic that manufactures revenue out of thin air. Now, what do I mean by that? So you got a big tech giant. Let's use Nvidia as the example. They don't just sell a chip, okay? They have taken a $100 billion allotment and invested it into OpenAI or a company like CoreWeave. On the balance sheet, this looks like a cash outflow dedicated to the purchase of an asset. However, here's the catch. The investment comes with strings. The startup, OpenAI or CoreWeave, is contractually obligated to spend that $100 billion back with the investor. OpenAI takes Nvidia's cash and immediately signs a contract to buy millions of Nvidia's H100 chips. Nvidia then reports $100 billion as organic revenue growth. Wall Street sees that, and they apply a 30 times or 40 times multiplier to the stock price for Nvidia. So the initial $100 billion investment just created $3 trillion in market capitalization thanks to high finance sleight of hand. Now, we know it's a closed loop. I mean, we saw that with some of the illustrations we saw in the clips. So it's the financial equivalent of a snake eating its tail, essentially. If the startup, in this case OpenAI or CoreWeave, can't find a real human customer at some point to pay for that AI, then this loop is going to snap. and the revenue vanishes. And when that happens, now we're looking at a possible bailout of AI companies. Why? Because Congress is positioning AI as an essential to national security service. And they're not going to let these AI companies fail. They're going to be too big, too vital to fail. Watch. And guess who's going to be left holding the bag? The same people who were left holding the bag in 2008 during the Great Reset, the same people who were left holding the bag in 2020 when the retail giants were the beneficiaries of a taxpayer-funded bailout.
Please, Ted.
Listen, this is the single most important economic question in the country and in the world. Who wins the race for AI? You look back to the 1990s, there was a similar inflection point with the beginning of the internet, the dawn of the internet. And Bill Clinton was president at the time. He signed an executive order, just like you're doing, that put into law a light touch regulatory approach to the internet. And the result was incredible economic growth and jobs in the United States. At the same time, the European Union took a very heavy-handed regulatory approach. Here's an amazing statistic, Mr. President. In 1993, the U.S. economies and Europe's economy were virtually identical in size. Today, America's economy is more than 50% larger than Europe's, and the two drivers of that are tech and the shale revolution. It transformed this country, and AI is the same thing. It's a race, and if China wins the race, whoever wins, the values of that country will affect all of AI. We don't want China's values of surveillance and centralized control by the communist government governing AI. We want American values of free speech, of individual liberty, of respecting the individual. So this executive order, I believe, is tremendously important. Thank you for your leadership.
Well, thank you.
All right, so you saw there, the board has been set. AI is being positioned as very relevant and essential to not only economic security of the nation, but national security. And so the exuberant spending that we're seeing from these AI companies could fall back on us. Remember, the mortgage companies and the banks, they got high on their own supply, and they were spending willy-nilly. And what happened? We had to bail them out. All right, so why does this matter to you? Okay, because you probably have a 401k, IRA, other retirement or savings. So yes, this does matter to you because your retirement is no longer as diversified as you may believe it is. So we got to talk about that. We got to talk about the solution to making sure you don't get run over when this circular firing squad from these AI companies comes full circle. So when you go out there and you invest in an S&P 500 based index fund, you're essentially handing over your money in large part to 8 companies: Nvidia, Microsoft. Now, Nvidia is providing the chips. Microsoft is the cloud giant funding all these startups along with Nvidia. Apple, it's a consumer gateway. Google, which has the AI infrastructure, is also a consumer gateway of sorts. Amazon, don't think of them as much as a consumer gateway as the backbone of this. Okay, AWS, Amazon World Services, cloud storage, data centers. Meta, the social data engine. Okay, and Tesla is an outlier more so in robotics. These Teslas on the roads, they're rolling robots. And then you got Broadcom. As of late 2025, those 8 companies make up nearly 40% of the entire S&P 500. So if this circular funding loop between the AI companies, Nvidia, Microsoft, and the AI labs, if all that fails, your index fund doesn't just dip, it faces a systematic heart attack. So unbeknownst to you, you might be leveraged into a Ponzi scheme disguised as a tech boom. A lot of people got caught out there like that during the 2000 internet bubble, right? So it gets even worse. Okay, there's a different layer of exposure here, and it's these what are called GPU collateralized loans. Sounds a lot like something that might have happened back in 2008. So you got startups like CoreWeave, right? They're taking the chips they purchased with borrowed money and then using them as collateral to borrow even more cash from private credit firms like Blackstone. So they're racking up billions of dollars in off-balance sheet debt. Now, what happens if the resale value of those chips drop? Which it will once the physical wall of water and power scarcity we discussed on a previous episode hits. Okay, once it happens, the loans are going to be called. So we're looking at a margin call of an entire industry, a margin call of epic proportion. So now the question becomes, how do you protect yourself? You've got to check your concentration in these various stocks, okay? And again, no longer can you afford not to be an active participant in planning your own economic future. If your 401k or IRA or what have you, if your portfolio is 100% in an S&P 500 fund, then that means you're 40% involved in the AI loop. So it may be time to start rebalancing some of that. We're not saying that having exposure to that is a bad thing, but what I am suggesting is that being overexposed could work to your detriment. So we talk about infrastructure and hard assets, right? So consider moving toward companies that actually own the plumbing, the ones who sell the water and the power to these data centers, regardless of whether the AI startup survives. So we talked about the companies that are in the supply chain for the small modular nuclear reactors. Make sure you take a look at those. Now, here's one that's a little, untraditional. We talked about these 530A accounts that the Trump administration is putting together for children. Okay, putting money in there is a way of building legacy for your kids or grandkids. So that could be an option as well. And because they're younger, the children are younger, they have a much longer investment horizon. So you could leverage that with planning for their future. All right. They're designed to be a safe harbor from the exact type of institutional debt collapse that we're potentially seeing with AI. So, listen, do you think the Magnificent Seven plus Broadcom, those companies that we went over, do you think this can keep going? How long do you believe it can keep going before they have a clear-cut method of monetizing AI? ChatGPT is free for the first few, questions, and then if you wait long enough, you can re-up and start asking again for free, right? Let me know what you think in the comments. Do you think this information is going to cause you to look at your portfolio and rebalance? Or are you just going to say you only live once and roll the dice? Let me know.